Mike Wilson of Morgan Stanley writing, this week's reciprocal tariff announcement is likely a stepping stone for further negotiations as opposed to a clearing event. Mike joins us now for more. Mike, good morning.
Good morning, John.
Why is that distinction important?
Well, I think that everybody's looking for like a final piece here. This is gonna take time, and not unlike a lot of the other policies that have come out this year. Like this is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative, and that we've likened this to a new CEO coming in, right? They want to restructure the company. They're restructuring the company. They're going to kitchen sink it. And then they're going to try to make their plan work for next year. So this is going to take some time. And this level that we're at now is critical from a market standpoint, not so much from the administration standpoint. I think that's also something to acknowledge.
It's also very on brand for Trump to take a maximalist approach in the very beginning. But how messy could it be if he comes in with this maximalist, aggressive approach, and then we have retaliation from trading partners? Well,
look, it's the NAFTA. So, it's the best alternative to a negotiated agreement, and the BATNA, and that is classic negotiating tactic. You come in and way over here to the right with the hope of kind of settling in the middle. So I don't think that's unusual either. The response from trade partners is that means they're engaging. Okay, so that's how you get people to engage in your discussion. You come out with a big splash. They have to come to the table and negotiations begin. We're not even at the table yet. Okay, so that's why this is going to be very uncertain for a period of time.
I think some countries think that they are at the table because they sent a few representatives here the past few weeks, but I agree with you. It really hasn't started. So what do you do if you're an investor?
Well, you've done what we've sort of done. You avoid the areas that are going to be most affected. Consumer discretionary goods, and that area has been hit the hardest, so maybe that's getting a little bit extreme. I would say, defensively positioned, high quality, that's been our core portfolio. Now, we've made some trading calls lately that would have gone against that. Some of those worked, some of those didn't work. But I think at this point, you want to be up the quality curve. You want to be in businesses that can kind of mitigate some of these concerns. You have pricing power. You have the ability to kind of move production around. You can take inventory on to kind of buffer this for 60 or 90 days, which we've seen all of those mitigation strategies, something we wrote about in our note today. So those are the kind of companies we want to own in this period of time. I do believe there will be a clearing event at some point this year, but we're not there yet.
Some of the changes you have made that are working, let's talk about them. International, DAX this morning, down 2%. Nikkei overnight, down 4%. International starting to turn. Subtle change from where we were over the last month or so. What's changing?
Well, that's right. And so last week's note, we kind of made the call that U.S. probably does better than these other regions because at the end of the day, those regions you mentioned are most sensitive to global trade, particularly Japan. So the fact that was down 4%, I think, is another sign that, hey, actually the market now is laser focused on this tariff or trade issue as opposed to some of the other issues that it's been kind of worrying about here. So that relative value, if you will, still looks good to us. It may happen in a down tape, okay, which is also something to consider because the U.S. is still the highest quality market in the world, and in a uncertain world, high quality will outperform.
But you think those European longs that have built up over the past few months, they might be in trouble here?
I think that's right. I think there's a little extension. Our European strategy team is in the same page. There are some good things going on in Europe that haven't been happening for decades potentially. But boy, that's going to take even longer than this sort of tariff negotiation. You're talking about countries spending more money on fiscal deregulation. This is a multi-year transition in the stock market. Some cases are up 15-20%.
So besides Rheinmetall or any other industrial military company in Europe, do you like anything there?
Well, I think the financials have been still a place to think about that have a potential structural change, a benefit in that regard. I think things that have levered to the consumer, but once again, these kind of got extended, and from my standpoint, I think there's better value now in the U.S. in some of these areas.
I'm sure you saw the new numbers coming out of Goldman Sachs and the team. New forecast from Jan Hatzius, if we can just throw them up on the screen. 1% on GDP. 3.5% on PCE. That's a stagflationary mix. What are you telling clients that are asking you about how we would trade stagflation in America?
We're not quite in the stagflation camp. We're more in the camp that expectations are probably not where reality is, which is that growth is worse than people thought, and inflation's a bit stickier, and that's how we came into this year. So we didn't mess around with our year-end targets, but we have been messing around with our short-term targets. So we're in that 5,500 to, I would say, 58, 59 now. We've kind of chopped off the upper end of that for the first half of this year. I'm not willing to throw in the towel yet completely on the full year because, as we've been saying, The good stuff of the policy changes that we expect could start to feed into the equity markets by year end. Could we push that timing out 3-6 months? Sure. But right now we're still in that 5,500 to 6,100 range with probably a truncated upper band. And now if you get universal tariffs, which is something that we talked about in this morning's note, then that lower half, that lower end of the band maybe comes down. So we're, if we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
Can we talk about the rebalancing you're expecting, though? The ultimate vision of this administration and why you still believe the more complete policy mix is still bullish?
Yeah, I think it's constructive. I'm not sure it's wildly bullish because, valuations were probably the biggest constraint coming in. I think it's bullish for a lot of parts of the market that have underperformed for the last 3 or 4 years. I mean, our vision, or I think the administration's vision, quite frankly, is very simple. They want to effect a slowdown in government. They want to kind of liberate the private economy through things like deregulation, keeping tax rates lower. Maybe tariffs are part of that storyline, fine. And that transition from kind of public government allocation of resources to private enterprise allocation of resources actually leads to a broadening out, something that's been absent really for the last 2 or 3 years. Something we've talked about here many times is this crowding out feature of the government crowding out small businesses, crowding out the average consumer. And look, I think they've been crystal clear in sort of their messaging. It's not going to be fun for a period of time. Okay, we have to sort of detox, as the Secretary Treasury mentioned. That there's going to be an adjustment period, as the president has said. So it's been crystal clear what they've been doing.